Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 28th of October. It's been a rather more difficult week in markets this week, particularly in the US, where some of the euphoria has worn a bit thin. There's a few things coming together. The bond market is slightly concerned that interest rates may remain slightly higher for slightly longer on the basis of the resilience of the US economy, on top of which there's always uncertainty leading up to an imminent US election where the candidates still seem to be somewhat neck and neck. On top of that, of course, you've got the geopolitical concerns, the escalating Middle East crisis. It's certainly not been a disaster, but some of the earnings that have been coming through have also been positive but underwhelming. On the one hand, you've got results which did shoot the lights out from the likes of Tesla, but on the other hand, IBM slightly disappointed. All that being said, it's not done too much to dent the performance of the main indices in the year to date. The Dow Jones is up by 12.4%, the S&P 500 by 21.8%, the Nasdaq by 22.7%, and the FTSE 100 has had a respectable return so far of around 6.8%. Turning to next week, there's a number of third quarter updates coming along from FTSE 100 companies worth keeping an eye out for. The first of those is Next. Share price has risen by about 44% over the last year. This is a company which is getting increasingly famous for being able to underpromise and over-deliver, has seen in quite a few consecutive quarters of profit growth guidance. Its latest upgrade took its estimate for the full year pre-tax profit number to be £995 million, and it'll be interesting to see whether they can tick that up again to the magic £1 billion mark. In the meantime, look out for contributions in terms of full price sales and indeed online sales, and whether they've made more progress on their overseas presence. Also, Q3 numbers to round off the banking season from HSBC and Standard Chartered. They're probably underperformed in comparison to the ones we've heard from so far. Over the last year, HSBC shares are up 11%, Standard Chartered up 21%. But of course, the thing that's held them back slightly here has been the performance in Asia and China, where they're especially exposed. That being said, the long-term possibilities for that region very much are intact, and if you look over the last 3 years, these two banks have probably outperformed, with HSBC adding 56%, Standard Chartered adding 76%. Apart from the Asian focus, it's also worth mentioning they're both getting into the wealth and affluent sectors, so we'll be keeping a close eye on any progress there. Finally, third quarter numbers from Shell. The shares have actually slipped by 6% over the last year, obviously driven by an oil price which, despite all the tensions in the Middle East, has actually dropped by 3.5% in the year to date. Some of that's driven by oversupply, of course, and uncertainty around the strength of Chinese demand. That aside, in terms of Shell, look out for any further news on the dividend. Shares currently yielding about 4.1%. What's happening with their refining margins, and of course any progress that they might be making on renewable energy. Thank you for watching. Have a great week.